In recent years, environmental, social, and governance, or ESG, principles have become a major focus in the insurance industry, influencing how insurers assess risk, invest capital, and develop policies. But while ESG presents significant opportunities, it also comes with challenges, especially as insurers struggle to balance climate responsibility with financial stability. So where does ESG stand today in property and casualty, or P&C insurance, and where is it headed in the future? Let's break it down. In simple terms, ESG in insurance means integrating environmental, social, and governance factors into business decisions, underwriting, and investments. Environmental factors involve climate change, disaster resilience, and sustainability, how insurers respond to increasing wildfires, hurricanes, and floods, and whether they support industries that contribute to carbon emissions. Social factors focus on equity, fairness, and diversity, such as providing affordable insurance in underserved communities or ensuring fair claims practices. Governance refers to ethical business practices, transparency, and risk management, including how insurers disclose climate risks and ensure compliance with regulatory frameworks. Many insurers initially embraced ESG as a way to future-proof their businesses, but over time ESG strategies have faced growing challenges, especially when it comes to climate-related insurance policies. One of the biggest opportunities for ESG in P&C insurance is climate resilience. Insurers have a critical role in helping businesses and homeowners adapt to extreme weather events, whether through encouraging stronger building codes and infrastructure improvements, offering premium discounts for sustainable construction and risk mitigation efforts, or investing in renewable energy projects or sustainable businesses. Another ESG opportunity is in social impact insurance, providing coverage for low-income communities, small businesses, and developing regions where traditional insurance markets may have left gaps. Insurers that take a proactive role in risk reduction and community support can help strengthen long-term market stability while addressing social responsibility goals. But ESG also comes with major challenges. One of the biggest is the increasing cost of climate-related claims. With rising wildfire, hurricane, and flood risks, insurers are struggling to balance ESG commitments with financial sustainability. Many have pulled out of high-risk areas, leaving policyholders in states like California and Florida scrambling for coverage. Another challenge is political and regulatory pushback. Some policymakers argue that ESG-driven insurance practices, like restricting coverage for fossil fuel companies or raising rates in climate-prone areas, could hurt economic growth. As a result, some states have introduced anti-ESG regulations, limiting how insurers can incorporate climate risk into underwriting and investment decisions. Just a few years ago, many of the world's largest insurers publicly committed to net zero emissions and pledged to phase out support for fossil fuel projects. However, in recent years, several major insurers have abandoned or scaled back these commitments, citing economic pressures and regulatory uncertainty. Some of the key reasons for this ESG pullback include financial strain from rising catastrophe losses, making it harder for insurers to focus on long-term sustainability goals. Pushback from governments and industries, particularly in regions where fossil fuel projects remain economically important. Challenges in enforcing ESG policies consistently across global operations, with different countries and states having competing regulations. This shift has created confusion and division in the insurance industry. On one hand, insurers recognize that climate risk is a growing financial threat, but on the other, they must navigate the realities of short-term profitability and political pressures. Despite recent ESG setbacks, it's unlikely that insurers will abandon ESG entirely. Instead, the industry is moving toward a more balanced, data-driven approach, where ESG is integrated into risk management rather than being driven solely by corporate pledges. Expect to see more refined climate risk modeling, where insurers adjust premiums and coverage based on granular, localized climate data, rather than broad ESG policies. Stronger regulatory frameworks around ESG reporting are on the horizon, requiring insurers to disclose climate and social risks more transparently. The rise of parametric insurance is noteworthy, where policies automatically trigger payouts based on measurable climate or disaster thresholds, helping insurers manage catastrophe risks more effectively. A shift toward customer-driven ESG choices, where policyholders may be able to opt into sustainability-focused coverage options, rather than insurers enforcing ESG through blanket policies. ESG in P&C insurance is at a crossroads. While the industry recognizes the need to address climate risk, social equity, and governance best practices, the challenges of rising losses, political resistance, and market volatility have forced a shift toward a more cautious, risk-focused ESG strategy. For consumers, businesses, and policymakers, the key question moving forward will be how to balance sustainability with affordability, ensuring that insurance remains accessible while still accounting for the long-term risks of climate change and social responsibility. If you found this helpful, don't forget to like, subscribe, and stay tuned for more insights into the evolving world of insurance. See you next time.